Hello everyone and welcome back to the channel. In this video, I'll teach you exactly how to invest in stocks for beginners. We'll go over everything you'll need to know to get started investing right away. It will be in parts, so I recommend you watch all of the videos to appreciate it. If you've ever wanted to learn how to evaluate individual stocks of companies, if you want to learn how to open a stock trading account, and how to make money trading in stocks, this is the guide you've been looking for. It is entirely free. I only want to help and urge you to begin investing right now. So these are the topics we'll be discussing. First, we'll go through why you absolutely must invest right now. We'll also go over what stocks are and the way people make money. We'll then go through the many types of stocks that you may buy and the simplest approach to create a trading account. Now I'm going to walk you through a couple applications and show you how simple it is, and then we'll discuss different account types and the overall idea of market timing. We'll go through the best technique to conduct stock analysis and any important terminology you should be aware of. We'll also discuss the two main methods that you may earn money with stock investment, along with how you could deal with taxes while investing. Also, when you make money and when you lose money. We'll go through some basic tax techniques that can help you save money. We'll also discuss value versus momentum investment, as well as Warren Buffett's investing concepts, which have served him well. We'll discuss how long or short you must hold your stocks, the benefits of investing early, how much money to start investing with. Believe me, you will not need a lot, and how to perform due diligence. I'm extremely happy about this video. Let's get started. Let us now discuss why you should invest now, and it all boils down to the concept of compound interest. Compound interest may make you a lot of money, and every minute you don't invest is money wasted. If you truly want to be rich, you have to create passive income, and investing in stocks will help you achieve that. It will make your money work for you as you sleep, so you will not always be sacrificing your time and effort for money. You must understand that time in the market is far more significant than timing the market, which essentially means that you should begin investing as early as possible rather than attempting to time the market's lows and highs. That is extremely difficult to do, and the majority of successful investors spend the most of their time in the market instead of attempting to predict the highs and lows. That is why, regardless of market conditions, it is important to begin investing as soon as possible. When looking at the long term, investment is both safe and beneficial. Let's discuss inflation for a minute because I know it's in the news frequently. Inflation may have varied, but it is now at 9.1%. Which indicates that money is decreasing in value over time. To generate wealth, you must invest your money such that it increases quicker than inflation. It is one of the ideal inflation protections, so if your money is only sitting in the banks, it is depreciating. Instead, you need to invest your money to increase. Most saving accounts currently pay less than 1% APY, which is considerably below the inflation rate, implying that your money is still depreciating. Real estate and other assets can gain faster than inflation, but you already know that this video is all about stock investment. Everything is currently on discount. All three main stock market indices are down year to date, and when the markets are down and people are afraid to invest, this is really the perfect time to invest. This is an excellent opportunity to increase your income and invest. The average bear market in the previous 140 years has seen a 37% loss. And the point is that we can never forecast the bottom. And the typical bull market can last more than 5 years with a 200% return. So it is very plausible that the S&P 500 will be over 7,500 by the year 2028. In this chart, it will show you why you should start investing as soon as possible. For example, if you start investing $5,000 per year at the age of 22 and compare it to investing $5,000 per year at the age of 32, a gap of 10 years, you can see that if you retire at the age of 67, the person who started at the age of 22 will have over $1 million, compared to $557,000 for the person who began investing just a decade later. And those 10 years truly help us to double the money at retirement. And this is due to exponential growth. You need to stay in the market as long as you possibly can, and every extra year will boost your overall result by a huge margin. Let me know in the comments if you have any other questions about investing. Let's return to the video. Now let's define the stock market, which is essentially a marketplace where buyers and sellers trade company shares. The SEC, or the Securities and Exchange Commission, regulates it in the United States, and publicly listed companies make their shares accessible for anybody to buy and sell on the open stock market. They go public by performing an IPO, or an initial public offering, which simply means that an investment bank buys up the company shares in order to take on the risk, and then sells those shares on the trading market for a fee, which is usually a percentage of the share price. In the United States, there are 13 primary exchanges, such as the NYSE, NASDAQ, Amex, Dow Jones, and so forth. It's really amazing because this entire system allows individuals to buy and sell in a regulated system, just like an auction. Why would a company want to IPO? It allows businesses to raise money via share sales and enables investors to be involved in leading companies' financial accomplishments. So let's go through what a stock is in more detail. Essentially, it's a small piece of a company. By purchasing one share of stock, you own a portion of the company, with your share of ownership, which is a sort of money supported by the company's units of stock, which are called shares. So whenever you buy one share, you own one piece. And as previously said, businesses sell stock to acquire funds for their operations. You can possess a single share of a corporation, several shares, or even fractions of shares. For example, if you go at Google stock or Alphabet Incorporated, we notice that they're trading at over $122.65 a share. So if you paid $122.65 today, you'd effectively acquire one share of Google, along with over 6 billion shares outstanding. So if you purchase one, you'll own one of the 6 billion share of the company. You may even purchase fractional shares. And if you don't even have $122 to invest, you can put in as little as $30. That will buy you 1/4 of a share, and a number of platforms enable you to do this, which we will discuss in more detail in a future video. Let us now discuss the various types of stocks available for purchase. The first type of stock is common stock, which is what you and I will both be trading. With common stock, you acquire ownership in a company as well as the ability to vote. So you have one vote for every share you possess. Some stocks pay a dividend, which we'll discuss further later, although they can be fluctuating and are not guaranteed. Over time, common stock may provide larger returns than many other investments. But with these higher returns comes a higher risk. You don't have any voting rights, but you do receive a more secure dividend that is earned before common stockholders. So if profits aren't large enough to pay both preferred stockholders and common stockholders, they're going to pay out the preferred stock owners first. And in the event of bankruptcy, the preferred stockholders will be paid out first. Because preferred stock is less volatile, it is more difficult to lose or gain value. The major differences between common and preferred stock is that preferred stock does not provide stockholders with voting rights, but common stock does. Preferred stockholders have priority over a company's profits, which means they are paid off dividends prior to common shareholders. And common stockholders are the last in line when it pertains to company assets, which means they will be paid over after bondholders, creditors, and preferred stockholders, but they receive the benefit of voting for a board of directors and company policy. Overall, simply be aware that these two types of stock exist, but you will most likely be dealing with common stock. Then there are ETFs and mutual funds, which both follow and invest in groups of stocks or assets. Mutual funds are a little more sophisticated in structure, but they're both quite similar in that they both follow some sort of index. Mutual funds are actively managed, thus their costs are greater, whereas ETFs are passively managed, resulting in cheaper fees. Mutual fund transactions cease at the end of the trading day after the final price is computed, but ETFs can be bought and sold all through the trading day. Now let's discuss categorizing stocks based on their size, and there are small, middle, and large cap companies. Market cap, also known as market capitalization, is the entire worth of all the company shares combined. So a small size company has a market cap of $300 million to $2 billion. A middle-sized company has a market cap of $2 billion to $10 billion. And a large cap company has a market cap of $10 billion or more. You may also categorize stocks by sector. So you have tech stocks, energy stocks, auto stocks, and so on. You could also categorize it by location. So you have companies based in the United States, China, Europe, and other countries. And there are growth versus value stocks. So growth stocks can potentially surpass the market due to their future potential. So both are generally going to be tech stocks like Microsoft, Apple, Meta. So growth stocks get the potential to increase a lot of value, but they are also more volatile and risky. When compared to value stocks, they are companies that are now selling at a discount and on a risk-adjusted basis. Value stocks have traditionally outperformed growth stocks, but this does not always imply that value stocks are superior to growth stocks. Therefore, most individuals choose to invest in a mix of the two. It all depends on your position, risk tolerance, and time frame. Let's discuss various risk tolerance levels and where stocks fit in. As you can see, cash has the lowest risk tolerance since it's simply money in its simplest physical form. But with inflation, I'd admit cash is in fact a little bit riskier right now because just keeping cash right now means your money is essentially losing its value. However, in the larger scheme of things, you're not investing your money in anything that may go up or down. So I definitely say cash is the safest option. Bonds are next, which provide minimal yields while being quite safe. Following that, there are index funds, which are useful if you wish to invest in like the S&P 500. This is far safer than investing in individual stocks, since index funds invest in the market as a whole. The risk is spread out among hundreds of various companies. However, with individual stocks, certain companies could go out of business and you may lose all of your money, which is why index funds are a better investment. Following individual stocks, there is real estate, which is a little riskier than investing in stocks, and even worse than that is the crypto. Right now, cryptocurrency is extremely volatile. We've seen some extremely large gains over the last couple years, but we've also seen some extremely large price drops. I'd assume that trading options is the riskiest of them all because you're highly leveraged if you do this, and it is also very easy to lose all of your money. I'd say that many people who try trading options will lose their money, which is why I don't want to discuss trading options in this video. So that's it for this video. See you in the next part. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.